Hello everyone and welcome to Stockbusters on TFNFinancialNews.com. I'm Andrew McCord. So here we are well into August. The mercury is hovering around the mid-90s all over the country. And if you're like many Americans looking to beat the heat, you've probably headed over to your local shopping mall for some air-conditioned retail therapy. But just because the lines at the food court are long and the wait for the dressing room even longer, there's no doubt that the retail industry as a whole is taking a big hit this year. Subprime mortgage lending woes seem to be spilling over into the credit card industry, with credit card lender MasterCard seeing its stock drop 24% in the last couple of weeks, and the retail holders index down 8.23%. So if you're holding retailers in your portfolio right now, it might be a good time to reevaluate your positions. And joining me today to discuss one particular stock she believes is toxic for investors is Ann Cisnowski, Executive Director of Diligent Investor. Ann, thanks for joining us today.
Great to be here, Andrew.
Okay, and so tell us, which retailer are you so bearish on right now and why exactly?
Well, Andrew, while some of the retailers and credit card insurers could bounce back a little in the short term, I'm warning investors that Tiffany & Company is a goner with or without macroeconomic influence. Now, Tiffany is one of the world's most well-known jewelers, a company with a market cap of over $6 billion. The company's wares literally make people drool. Now, I know this for a certain fact because when a woman in our office showed her Tiffany engagement ring off a few weeks ago, every woman's mouth dropped in astonishment. The girl was poked and prodded like a lab rat just so everyone could get a closer look.
Well, sure, it's Tiffany. I mean, that means it's got to be good, right?
Well, of course. I mean, Tiffany makes beautiful stuff. There's no disputing that. But it's not all shine for them recently, and it won't be for some time coming. Granted, Tiffany's just won an injunction in a counterfeit lawsuit that fined John Shamir of Starglam Inc. almost $1 million for distributing fake Tiffany jewelry from Asia on the internet. But that hardly outweighs the bad news that's been flooding their way. Now, this win was sideswiped by a downward revision of the jeweler's second quarter earnings report. Specifically, the company admitted that it's going to incur a loss on its sale of its Little Switzerland jewelry shops to the NXP Corporation. It's a staggering loss, Andrew, actually, to the tune of 15 to 18 cents per share. Now, Tiffany's has yet to announce a sale price, but plans to on August 30th when it reports its second quarter earnings. The announcement of the costs incurred for the sale of Little Switzerland, which are 25 duty-free shops that are based in the Caribbean islands and Florida, erased half of analysts' expectations of 35 cents per share for the company's second quarter earnings, pushing it down to a range of only 17 to 20 cents per share. And that's only if the company plans to meet the 35 cent per share expectations in the first place. With this mixed news, Tiffany has fallen to its 200-day moving average, a make-or-break support for virtually all stocks. In fact, after hitting a 52-week high of $56.79 per share in early July, Tiffany's stock has dropped to $45 per share, tearing off 21% in value in only 1 month.
Okay, so 21% is a pretty sizable hit, but what's in store for Tiffany now, Ann? Is the worst over for them?
No way, absolutely not. If you're holding any Tiffany stock, it's time to purge it from your portfolio immediately. Now, ever since 1999, when Tiffany was valued at only $10 to $13 per share, its stock has performed extremely well. But like all stocks, it's also cyclical and is currently in a bearish trend. If you do some quick technicals, you'll see that since 2002, Tiffany has never failed to fall below its 200-day moving average once it touched it. Now, it's really a matter of noticing a stock cycle, and I have no doubt that we could see another 24 to 27% retracement on Tiffany in the next 6 to 8 months from its current price, which will bring the stock value of the jeweler down to around $33.50 per share.
Wow, that's a pretty drastic fall. Are there any other signs backing up your prediction here?
Absolutely. Just look at Tiffany's CFO, James N. Fernandez. He saw it coming. He just recently sold 15,000 shares of Tiffany stock in late July at $55 per share. The stock's already $10 lower today, and it's still dropping. This is definitely not a good time to hold on to Tiffany stock. The company continues to lose its net income on a yearly basis. It's going to see poor earnings going into retail's biggest season, and it has high debt compared to cash. Its technical stock picture is beyond poor.
Okay, so in the few seconds we have left, I think I know the answer to this already, Ann, but what should we do with Tiffany? What should investors do right now?
Well, Andrew, take whatever gains you have and call it a closed position. I wouldn't look to buy it until it hits a low in the next 6 to 8 months and begins its cyclical ascent again up toward its 200-day moving average.
All right, good stuff. Thanks for being here, Ann, and we'll keep an eye on Tiffany in the coming weeks.
Thanks for having me, Andrew.
You can read more of Ann's analysis on the retail sector and other cyclical investment trends at diligentinvestor.com, which can be accessed on the main page of the TFN site. Thanks for joining us on Stockbusters. I'm Andrew McCord. Until next time, keep your portfolio safe.